Welcome to episode 1 of the Investing is Hard podcast. Think of this as a no bullshit guide to what can go wrong in investing. Today we are looking at an Australian company, Dubber. This is basically the finance version of the robot chicken gummy bear trap. If you don't know what that is, there will be a link in the description. Pause this, go watch it. It's only 30 seconds, and then come back and you will have a good idea of what we're about to go through. Before we get started, a few housekeeping items. First, this is a case study, not investment advice. I'm not long or short and don't plan to be. Second, all dollar figures are in Australian dollars. Finally, shout out to Unemployed Capital Allocator on Twitter. This case came from him. All right, think about all the conversations going on in the business world every day: sales calls, customer support chats, compliance, banking, patient consultations, team meetings on Zoom or Microsoft Teams, whatever. There's a lot of value in the audio data if you can capture it, transcribe it, analyze it, extract some sort of valuable insight from it, and that was Dubber's pitch. They called it Unified Call Recording. It was a cloud service. Basically, if you've ever been on a call and hear this call may be monitored or recorded for quality and training purposes, you're probably under surveillance by something like Dubber. There's actually an article from July 2022 titled How Dubber Fights Financial Fraud with AI and Data. Talks about compliance intelligence, reducing the risk of fraud, both internally and externally, which you'll realize how funny that is by the end of this episode. Now, instead of selling to one business at a time, Dubber focused on integrating their technology directly into the world's largest telecommunications and unified communications providers. So think of companies like Cisco and their BroadSoft platform, where tens of millions of people around the world use their voice services. Dubber software would be embedded right into the network. So when they sold a phone plan to a business or government customer, they could just say, hey, for a few extra dollars a month per user, you can switch on call recording, AI analysis. Just tick this box. It's a smart, low customer acquisition cost and highly scalable model. For a time, the strategy seemed to be working great. By their 2022 fiscal year report, Dubber was deployed on over 175 service provider networks with around 580,000 subscribers on the platform. They also did a number of acquisitions. I'm terrible at pronouncing names, which maybe I should have thought about that before starting the podcast. But they bought up smaller tech companies like an AI-powered note-taking service, a UK-based call recording company. From January 2019 to July 2021, so around 2.5 years, Dubber's stock increased 8x. So in July 2021, Dubber did an equity raise for $110 million at a price of $2.95 per share. And this is 2021, so there's the pandemic, tech stocks are on an absolute tear, money's cheap, investors want high growth. Dubber has a great service, a scalable business model, over 500,000 users and growing. The balance sheet has $110 million in fresh cash. What could go wrong, right? First, the macro environment cooled. 2021 was peak everything, so by August 2022, Dubber's stock is down roughly, oh man, good times, 75 to 80% from that $2.95 price that it raised capital at. Hardly unique. Even a company like Meta was down 50% during the same period, but man, this is before we even get into the good stuff. So, shares now are trading around 60 to 70 cents. Still, August 29th, Dubber's preliminary final report for fiscal year 2022 showed revenue up 55% from the previous year to almost $36 million. These were still unaudited numbers, but the audit was in progress. So by this point, the stock is down a lot. But with that kind of growth, maybe it's an interesting situation to look at. Then came October 2022. Monday, October 3rd, Dubber went into a trading halt because it couldn't lodge its audited fiscal year 22 on time. When the audited report was finally lodged at the end of the week, revenue was restated from $35.6 million down to $25.3 million. That is a 29% reduction versus the preliminary numbers. Now, the official explanation was a, quote, modification in the treatment of platform and foundation-based income under AASB 15. Love it. Basically, they were recognizing invoices too quickly, and the auditors told them they had to defer revenue to match their services actually being delivered instead of the date the company was billing customers. For example, there were these foundation agreements where Dubber would sell a block of subscriptions for a flat fee, regardless of how fast the customers actually used them. Now, under AASB 15, Australia's version of IFRS, that revenue should drip in over the term of the contract, not be recognized on day one. And so the auditor flagged both revenue timing and collectability as key audit matters. Plus, there was another $8.2 million tied to collections issues, meaning they were having trouble actually getting paid for some of the revenue they'd booked. So altogether, an $18.5 million difference between the company's audited and preliminary report. That pretty much shattered management's credibility. The CFO resigned, market reacted as you'd expect, the stock fell again. Shares now are trading around 35 cents. And so in response, in February 2023, the company announced a formal restructuring to try and get a handle on their cash burn. That included layoffs, cost controls, all the usual stuff. They are also caught up around the same time in the Silicon Valley Bank mess, trying to recover $1.3 million from that. All of this took that $110 million cash balance that they had in December 2021 down to $26 million. Then, March 2024, Dubber again enters a voluntary suspension. The company needed to make an announcement regarding a, quote, anomaly involving a term deposit with a third-party trust account. Now, a term deposit is supposed to be the safest, most boring asset a company can hold short of physical cash. It's just money locked with a bank for a fixed period, earning a little bit of interest. So hearing about an anomaly in that context is not what you want. The other thing, obviously different parts of the world have different terms for things. Like in the US, we file with the SEC. In Australia, I guess they lodge. In the US, a solicitor is a 12-year-old who knocks on your door once a month and wants you to pay $7 for a Snickers bar. Point being, having a term deposit with a third-party trust account instead of a major financial institution like a bank, my first thought is, this being an Australian company, is that just how things are done in Australia? Is that normal? Or is it the red flag that it sounds like? The company reveals that a potential misuse of funds had been discovered. Surprise. Cash that had been placed in a trust account managed by a third-party solicitor, a small law firm named Christopher William Legal, was missing. $26.6 million to be exact. The board said it first saw the solicitor's trust account ledger, which was a ledger with all the transactions of cash flowing in and out of the trust account, on February 27th, 2024, and that documents provided about certain deposits may have been falsified. So the board immediately suspends the company's founder, CEO, and managing director, Steve McGovern. The matter is referred to ASIC, Australia Securities Regulator. By late March, ASIC, or ASIC, I'm just going to call it ASIC, had gone to federal court and by consent obtained travel restraint orders against both McGovern and the solicitor, Mark Madaffrey, preventing them from leaving Australia while the investigation was ongoing. Finally, April 9th, 2024, in a public announcement, the board confirmed that it had officially terminated the CEO. Alongside all of this, Dubber finally lodges its overdue interim results and an investor presentation with a summary of recent events. So the presentation laid out the board's internal investigation findings. One was that from mid-2019 to August 2021, the company had deposited around $60 million into the solicitor's trust account, supposedly for the purpose of investing in term deposits, which again, why not just put it in a bank? Anyways, the total amount paid into the structure since 2018 was almost $75 million. Of this, again, $26.6 million was still unaccounted for. As I said, the board said that documents provided to the company regarding these investments, quote, may have been falsified. They described a pattern where some of the funds were allegedly recycled back to Dubber to simulate interest payments. And they said that payments from the trust had reached, quote, certain personnel or their associated entities, which means that McGovern and the solicitor took the money, allegedly. In light of all of this, the company announces an emergency capital raise. Their cash balance now is down to $1.5 million, so they are on the brink of insolvency. And then came the moment of reckoning, as if there hadn't been enough already. April 17th, 2024, after the stock had been frozen for nearly 7 weeks, Dubber shares resumed trading on the exchange again. Market opened, Dubber stock lost around 75% intraday. It was one of the most brutal single day collapses in recent years or all time on that exchange. Shares then were down to around 5 cents. All right, so let's review 2 core failures and 2 red flags. First core failure was internal controls and governance. Loose internal controls allowed tens of millions of dollars to be sent to a third-party law firm's trust account instead of a major bank. Segregation of duties, dual proof, like all these boring treasury policy guardrails that companies have are designed to stop this type of thing from happening. Also point out that Dubber formally established a dedicated audit and risk committee in September 2022 after most trust account transfers had already happened. Now, granted, unlike in the US where Sarbanes-Oxley requires US companies to have an audit and risk committee, in Australia, it's not required. But if you don't have it, that oversight falls on the board of directors overall. The company did acknowledge control gaps around banking relationships and use of third-party intermediaries and took steps after the fact to tighten things with board-level approval requirements and stuff like that. Either way, guardrails at the time failed. The second point of failure was a breakdown of external assurance. This is where the auditors come in because they're the last line of defense for investors. And actually in June 2025, so just recently, Dubber sued their former auditor, claiming a competent audit should have flagged cash for term deposits being routed into a solicitor's trust. Again, those are allegations, not findings, but shows how that safety net can fail. Our first red flag was the reporting restatement. The October 22 revenue restatement that coincided with the departure of the CFO. When a company tells you, whoops, we overstated revenue by over 40%. I mean, think like 40% of an entire business's revenue. Oops. It implies that management doesn't have a good handle on the business or that the numbers and or management can't be trusted. The second red flag was the non-standard treasury practices. You should question anything that seems to deviate from standard practice. Why isn't the company's cash just in a bank? Because guess what? If you read the footnotes in their financial statements, they told you that the cash at call deposit was held under the company's legal firm's name in a trust. That trustee setup is not normal, but it wasn't a secret. On its own, it doesn't mean there isn't a legitimate reason for it to be set up like that. But if you come across it, you better be asking the company point blank what that reason is. These types of accounts do exist, like small money set aside for negotiations with suppliers or something, but moving large amounts of treasury cash through it is not standard practice. So you may think that internal controls and governance issues can be difficult to see from the outside as an investor. But 3 of the 4 things we just covered, you could have noticed through proper due diligence. You could have noted the lack of an audit and risk committee. You could have seen the restatement and CFO resignation, and you could have noted the cash at bank and cash at call deposit in the trust account. Obviously, hindsight's 2020, but that's why we're doing this, right? So now you know. There's actually a great Substack article I read recently. It was called Control Fraud and Contemporary Adaptions. It's written by the Magic Bakery on Twitter. I love Twitter and Substack names. I'll link it in the description. Go give it a read. But the too long didn't read is that control fraud is when people who control a company use the company to enrich themselves or related parties and undermine the company in the process. And it lays out 4 recurring ingredients. 1 is accounting abuses. 2 is rapid growth. 3 is the ease of gaining and or retaining control. 4 is lax or forgiving oversight and or regulation. And it argues that those ingredients often show up together in a permissive ecology of boards, auditors, regulators, investors. And we saw several aspects of that with Dubber. Whether it crosses in the fraud, I'll leave to the regulators to determine. But The revenue restatement hits the accounting abuse point. The non-standard trust account cash handling speaks to control and oversight, and the company was clearly seeing rapid growth. So, if you're wondering where Dubber is today, it's still publicly traded. The stock currently trades around 2 cents per share. So, if you bought it basically any point in the past ever, you're down a lot. There was leadership and governance overhaul. The CEO was fired. A new permanent CEO was appointed September 2024 to try rebuilding the company. The board got new independent directors. You had the audit and risk committee put in. The company's balance sheet was wrecked. They did multiple emergency capital raises that were highly dilutive to existing shareholders. The ASIC investigation into the former leadership is active and ongoing. The company itself is trying to recover the lost funds, obviously. They are pursuing claims against the implicated parties. They're making a claim on the Victorian Fidelity Fund, which I guess is a sort of compensation fund of last resort for victims of misconduct by lawyers. And as I mentioned, they're now suing their former auditors in federal court. I did confirm with the CFO of Dubber that all their cash and deposits are currently held at A-rated banks in the jurisdictions they operate in, and none through trustees. So at least there's that. So what are the lessons from Dubber? First, governance is not boring, or maybe it is, but it's definitely important. There's so much focus all the time on the success or failure of an investment being on the product, service, maybe a visionary CEO. I'm 100% thinking of a specific company right now. But anyways, the boring stuff, the independent board, the audit committee, the internal controls, these things matter just as much. Dubber had a good business model and service, and they failed due to weak controls, reporting issues, and treasury practices. Second, read the tea leaves. That's basically an investor's job, right? An accounting restatement, a delayed financial report, sudden departure of a key finance executive. These are not minor issues. Yes, they happen. Sometimes they're justified, but should always make the hairs on the back of your neck stand up. Third, read the footnotes. Cash is not cash. The quality of the cash can be obscured in classifications and counterparties. If the cash sits in a trustee account or outside standard bank accounts, ask why. Complexity is rarely good, but especially when it comes to something as simple as where the cash is held. Fourth, trust but verify. The boards, auditors, the regulators, they're supposed to protect you, but they can fail. You have to be mindful of that risk. You never know everything that's going on in a company. And so you need to be doing your own due diligence, like reading footnotes, asking questions. I'll add one more lesson, which is more of a personal opinion. I think it's safe to say valuation matters. Even before we had all the internal failures, the stock collapsed from when it was being valued in nosebleed levels, and they, rightly so, raised all that capital. But bottom line, great products and business models will not save you from weak controls, messy reporting, and poor treasury practices. When you see restatements, delays, executive churn, cash held in odd places, assume the risk is higher than it looks, read the footnotes, ask questions. There's actually one other detail I omitted during this episode. It was another potential red flag, and somebody actually raised it in a blog post in 2017, years before everything we just learned about. I'm going to cover it in the next episode because it actually has to do with our second case study. But in the meantime, that's it for episode number 1. I hope you learned something or found it interesting. Feel free to send me feedback, whether you liked it or hated it. What were your takeaways? Did I mess something up? If you have a case you think should be covered, let me know. Share this with a friend, and until next time, say the line, Bart. Investing's hard.